Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and risk management. I'm your host, Lewis, and I'm excited to share today's story with you. As we explore the latest developments in the financial sector, we'll be discussing a topic that's been gaining traction: tokenization. Tokenization, in simple terms, is the process of converting traditional assets into digital tokens that can be stored and traded on a blockchain. This technology has the potential to revolutionize the way we think about ownership, trading, and settlement of assets. But as with any new innovation, there are also risks and challenges associated with it. Recently, European regulators have been weighing in on the topic of tokenization, highlighting both its potential benefits and drawbacks. According to a report by ESMA, the European Securities and Markets Authority, tokenization could bring about increased efficiency, reduced costs, and improved accessibility to financial markets. However, there are also concerns around investor protection, settlement finality, and custody that need to be addressed. The EU's DLT pilot regime, which allows participants to test tokenized trading and settlement under temporary exemptions, has been seen as a step in the right direction. But regulators are also calling for more clarity and cohesion in the existing framework to ensure that tokenization can scale safely. As we explore this topic further, it's essential to consider the global landscape. The United States, Asia, and Europe are all vying for leadership in the tokenized funds market, with billions of dollars invested in tokenized products this year. Technology firms like Google are also entering the fray, providing infrastructure support for tokenization. But not all rollouts have been smooth sailing. Some companies have faced criticism for their tokenized offerings, highlighting the need for regulatory clarity and oversight. As we navigate this complex and rapidly evolving landscape, it's crucial to approach tokenization with a nuanced perspective, acknowledging both its potential benefits and risks. We'll be keeping a close eye on developments in this space and exploring the implications for investors, regulators, and the financial sector as a whole. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our show, and I'm excited to dive into our middle segment. Today, we're talking about the seasonal trends in the stock market, specifically focusing on the month of September. As we've seen historically, September tends to be a challenging month for global equity investors. According to data from Carson Group's Ryan Dietrich, the S&P 500's average return in September is 168% since 1950. This makes it the only month with an average negative return over the past 75 years. Now, some analysts point to various reasons for this trend, such as fund managers dumping their worst-performing stocks ahead of the fiscal year-end or tax-related selling. Others suggest that investor psychology plays a role, with caution and pessimism becoming self-fulfilling prophecies. It's essential to note that past performance is not a guarantee of future results. However, it's also important to acknowledge that September has been a volatile month in the past. This year, with Wall Street's main indexes near record highs and valuations getting stretched, especially in the tech sector, the stage is set for a potentially rocky September. The Federal Reserve's expected rate cut on September 17 could provide some support, but it's crucial to remember that this is already priced into the market. The momentum is slowing, and investors are starting to rotate out of tech and into smaller caps. As Porter Collins, co-founder of Seawolf Capital, recently said, "When markets are this extended, an eyes-wide-open approach is advisable." With multiple potential catalysts for a correction looming, it's essential for investors to be cautious and aware of the risks. We'll continue to monitor the market trends and provide you with updates and analysis. For now, it's crucial to stay informed and adapt to the changing landscape. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got one more story to share with you before we wrap up today's episode. You know how Uber has been making waves in the tech industry with its innovative solutions? Well, it looks like they're taking it to the next level by tapping into their Indian driver network for a very specific purpose. It appears that Uber is leveraging their vast network of drivers in India to help with data labeling for their AI solutions arm, dubbed Uber AI Solutions. But here's the interesting part. They're offering these drivers extra income for completing micro-tasks, like tagging objects in photos. That's right, folks. If you're an Uber driver in India, you can now earn some extra cash by doing small tasks within the Uber app. Now, we know what you're thinking. How does this work? Essentially, Uber is using their drivers to help improve the accuracy of their AI models by providing human-annotated data. This data is then used to train and fine-tune their machine learning algorithms, making them more efficient and effective. We think this is a clever move by Uber, as it not only provides an additional revenue stream for their drivers, but also helps to improve the overall quality of their AI solutions. And let's be honest, who wouldn't want to earn some extra money by doing small tasks on their phone? But as with any new development, there are also potential risks and challenges to consider. For instance, how will Uber ensure that the data being labeled is accurate and consistent? And what kind of safeguards will they put in place to protect the privacy and security of their drivers' personal data? These are all important questions that need to be addressed as we move forward in this brave new world of AI-powered solutions. As always, we'll be keeping a close eye on this story and providing you with updates and analysis as more information becomes available. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.